Welcome to the TAC Index AI podcast, where we blend TAC AP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. Our mission today in this deep dive is really to explore how current air cargo trends, the broader logistics landscape, and, well, even the macro markets are being shaped. We'll keep a special eye on energy prices and those ever-shifting global trade dynamics.
Exactly. And to guide us through this kind of intricate web, we've pulled insights from the latest tech index market updates, and we're also looking at recent reports from Reuters, Bloomberg, and the Wall Street Journal. It's meant to be a comprehensive look, giving you a shortcut to being really well informed on what's happening right now.
Okay, great. So let's unpack this, starting with the TAC index data. What's jumping out at you? I see globally air freight prices, well, they eased slightly overall last week. So the Baltic air freight index, the BII 0, was down by negative 1.1% over the week to August 4th. Leaving it down negative 1.8% over 12 months. And this is typically a slow period, right? The low season.
Yeah, that's absolutely right. It is traditionally the low season. But what's fascinating here is while that global index eased, the picture is much more nuanced when you actually dig into specific routes. This quote-unquote low season is, well, anything but uniform. You see rates out of China to both Europe and the U.S. and also North Asia to Australia and Spain. They all saw some slight easing. However, there's this new lane from North Asia to India that actually saw rates rise. So some interesting counter trends there.
Ah, okay.
It just highlights, that understanding specific lanes is really crucial for anyone involved. Those targeted shifts are where the real opportunities or maybe risks emerge.
That regional granularity really is key, isn't it? Let's break down some of those specifics then. Outbound Hong Kong, BAI 30, was lower by naggish or 1.7% week over week. Shanghai, BAI 80, dipped just a tad, naggish of 0.2%. But then on the flip side, look at London. BII 40 gained, plus 2.1% week over week, and that's consolidating recent gains to be up a pretty significant plus 28.3% year over year.
Yeah, London's strong, and Chicago too.
Right. Chicago, BAI 50, also saw a robust gain, plus 12.0% week over week. That puts it back into positive territory year over year, plus 10.2%. And those rates from the U.S. down to South America seem particularly strong, up over plus 40% year over year, led by Miami, it looks like.
Exactly. London and Chicago are really standing out in this generally quiet period. And this complex pattern, slight overall easing, but these big regional gains and shifts, it's happening amidst these renewed uncertainties over higher tariffs. Remember, those were announced right at the start of the month by the U.S. president?
Yes, the tariffs.
Yeah, it's clear the market isn't just reacting to seasonal demand. These underlying policy shifts are constantly reshaping things.
And that connects directly to, well, the political landscape, which is having such a profound effect right now. It's striking how quickly these announcements can just ripple through global logistics.
Yeah.
President Trump announced that extra 25% tariff on Indian goods for buying Russian oil, and then a, 100% tariff on some chip imports. That's not just background noise, is it? That's an immediate impact.
Oh, absolutely. And if we connect this to the bigger picture, these sweeping tariffs, they've triggered this major diplomatic scramble, really. U.S. trading partners are all trying hard to secure exemptions. Japan, for instance, is urging the U.S. to quickly implement that agreed reduction in auto tariffs down to 15% from 27.5%. And they also want clarity on the no stacking condition, basically. Can new tariffs be piled on old ones? Especially since reports suggest the U.S. will stack tariffs on Japanese imports.
So much uncertainty there.
Exactly. What this whole back and forth reveals is this fundamental shift away from maybe rigid trade policies to something more fluid, more negotiated. It means businesses, they can't just assume blanket rules anymore. Agility, direct engagement, that's paramount now.
And some have had success with that agility. I saw Brazil got exemptions for quite a few products.
That did. Brazil secured exemptions for 694 products, which is about 43% of its exports to the U.S., from a 50% tariff, things like orange juice, even airplanes. Chile also managed to get copper, a huge export for them, exempted from a 50% tariff. So you see this shift from that initial no exemptions, no exceptions stance to allowing, limited exemptions, especially for products that cannot be made here. But it creates significant uncertainty. It impacts business investment, hiring decisions, prices, right across the macro market. It's this constant push and pull. And it also ties into things like secondary sanctions, too.
Secondary sanctions?
Yeah, like measures targeting foreign entities doing business with sanctioned parties. Think about the potential blacklisting of Russia's shadow fleet of oil tankers, vessels operating outside the usual oversight.
Right, okay. And beyond tariffs and trade talks, there's energy costs adding another layer here. We've seen Oil, WTI crude, fall recently. Fourth straight session, settling near $65 a barrel. How's that playing into things?
Well, this recent drop seems largely influenced by geopolitics. Specifically, Russia may be weighing concessions to the U.S., things like a potential air truce with Ukraine, maybe to fend off those threats of secondary sanctions we just mentioned, like blacklisting their shadow fleet. And it's notable that India and China have become major buyers of this discounted Russian crude. So this volatility in oil prices, it inevitably impacts overall logistics costs and, crucially, the price of jet fuel for air cargo operations. Makes planning even tougher.
Jet fuel costs being a direct hit there.
Yeah.
So wrapping this up, what does this all mean for you, the listener? We've uncovered a really dynamic picture. You've got global air freight rates, influenced by seasonal lulls, but highly reactive to political decisions like these new tariffs, and then further impacted by fluctuating energy costs, including, as you said, jet fuel.
Right. And it raises a really important question, doesn't it? How will all these interwoven factors, specific trade lanes gaining strength, the ongoing battles over tariff exemptions, the sheer volatility of global oil prices, how will they continue to reshape the efficiency, the cost, and ultimately the reliability of our global supply chains?
Exactly. And for you listening in, maybe consider how these profound shifts in how goods move around the globe could ripple through the economy. How might it influence everything from product availability on the shelves to the prices you pay, in your daily life? Something to think about.